What is going on, everybody? This is S Trades, and today's day 25 of the bootcamp. And in today's video, we're going to be going over how to take the highest probability setups. And without further ado, let's get straight into the video. So for the previous video, we made a video about my strategy, and I went in depth and pretty much how I trade, and it's pretty much just inversions off of higher time frame rejections, and it's a lot more specific and a lot more details than that. But just to simply put it, inversions off of higher time frame PD arrays, right? So now that you know how my strategy works, now you have to kind of tone down and see how to take the most highest probability, like the A plus setups, because what happens is inversions happen every single day, every single session, every single minute. Like, they happen literally starting from the 1, 2, 3, 4, 5 minute, 15, 50, 30, 45 hour minute. Like, literally it starts and it happens at every single time frame. Happens during Asia session, happens during London session, happens during PM lunch hour, AM, so the strategy pretty much happens all the time, right? But the specific statistics that I have, which is the 70% win rate, is specific to the AM session, right? And it's for the morning, right? So it's anywhere from 9:30 to 11:10, and that's kind of where my strategy does the best and has the most highest probability setups that happen, and the ones that obviously win the most, right? So like I said earlier, you have to kind of have a specific setup and a specific ratings for your setups, right? So if you, let's say, take CISD entries, right? CISDs happen all the time, right? How do you differentiate, like, for example, an A plus CISD, where if you look at it at a random chart and you'd be like, all right, this is A plus, this is what I will take any day of the week, this is just too obvious, right? Compared to like a random CISD where you're like, I don't know if that CISD is really good or not, right? I'm just giving a different example other than inversions. Let's say if you trade break of structure, same exact thing, right? And yeah, pretty much you have to have ratings for your setups, right? So you want to obviously take the highest probability ratings, or you want to only take A or A plus setups, because those are the ones that would bring you the most wins, right? So the four main things that I look at when taking the highest probability setups are pretty much these things right here, right? So first things first is I want to take the trades that align with my bias, right, for the most part, and with the current order flow in the market, right? So if you just open up your charts, let's say pre-market, or even when market open, you zoom out and you see what is happening in the market, right? Are we rebalancing inefficiencies? Are we rebalancing equilibrium? Are we taking out liquidity? Like, what is happening currently at in the market, right? Are we taking sell side? Are we taking buy side? Are we delivering from buy side? Are we delivering from sell side, right? So you kind of have to look at these things and see where is your current daily bias for today, right? Now, it's not necessarily that you're kind of getting married to your bias. Like, it's like, let's say if you think that you're bullish and then the market is presenting you all the bearish opportunities and is proving your bias wrong. I'm not saying just stick to the bullish bias, because a lot of the times you're going to be wrong with aligning to your bias, right? Let's say if you think you're bullish but the day is bearish, it would be more smart for you to adjust and switch bearish, obviously, if the market is showing you that, right? But let's say if you're looking at the morning in the morning, right? Let's say the trade, let's say the market kind of is delivering from sell side. Let's say we took London lows, right? And now we're disrespecting bearish gaps, so we're closing above bearish fair value gaps, and we're delivering higher. We're creating bullish gaps, and we're retracing to those bullish gaps, and we're continuously going higher and higher, right? We have displacement through the highs, and it's pretty obvious that the day is currently bullish, and there's still obvious draws in liquidity and still obvious liquidity left above higher for us to go to, right? So that is one thing, right? That's number one of the most important things that you look at, right? If the current order flow in the market is bullish, you ideally want to take longs, right? I'm not saying that bearish plays, like, let's say, shorts aren't going to work. Shorts will definitely and could work, but the highest probability setups for that day would be longs, right? Let's say if you're just continuously going up higher and higher and higher, right? Instead of trying to catch that one little retracing back down, which could be at any point, right? Like, it could happen here, or it could happen there. Like, you can't really tell. You could tell when it would happen, but it would be kind of hard to just snipe that one trade that will kind of make the bearish play work when you're currently very, very bullish. You know what I mean? So instead, what you want to do is you want to set up a bullish bias, and you kind of want to see for like a little retracement back down to like an equilibrium level, for example, or you want to see price come down to like a certain discounted 15-minute fair value gap, and then take a trade off of that, right? Instead of you trying to just take a random shorts, left and right, and losing, constantly. So that's number one. Number two is is there obvious draws on liquidity, right? So if, let's say, we're going from our point number one, let's say if you are bullish, right, and you want to take longs, now you want to see if there's obvious draws on liquidity still above higher, right? So let's say if you're, again, we're delivering from London low, right? Say we took out London low and now we're going up higher. We're disrespecting bearish fair value gaps, and we see above higher we have a London high, we have Asia high, and then we'll say we have a 15-minute high above, and then there's like equal highs above, right? So there's a lot of obvious draws on liquidity that are still left and are still, for you to target, right? So then this becomes a very, very important thing, because a lot of people don't realize, let's say if you're bullish, but then they don't see that all the main targets got taken, right? Let's say if 930 opens and then we immediately just shoot up higher and we take out every single high, right? We took out London high, we took out Asia high, we tapped into that, premium fair value gap, and now we're at all-time highs. Let's just say, right, we took out all the obvious draws on liquidity. Now there's nothing left for you to target, right? Let's say after that, let's say if you're in all-time highs, at that point you're just kind of hoping and praying it keeps on going up high, right? Obviously when you're all-time highs, you want to keep on taking buys, right? You want to keep on longing, but at some point you can't really tell where's the next draw on liquidity, right? So then this becomes a very important thing, because if you don't have an obvious draw on liquidity, it can be very, very hard for you to target anything, because at that point it's not that you're gambling, but you're kind of just hoping for some sort of target to get hit, because the way you have to look in the market, right, is there's a certain objective for the current session, right? For example, New York opens up, we have we have London high, Asia high, let's say equal highs above let's say there's equal highs above London, and then let's say there's like a 1 hour fair value gap, right? There's all of these objectives, right? All of these obvious draws on liquidity that are still left untaken. Like we haven't tapped into that, we haven't taken out any of these draws on liquidity, so they're still there resting. There's still orders there that you can target, right? But if they're already taken, the objective for the day is kind of taken, and we could possibly either see a chop, or we could kind of come down lower, right, and then maybe take out some of the lows to again fuel the move higher, or we could just keep on continuing high, right? So at that point your draws on liquidity are gone, and it's not really too obvious, and you don't really know what's going to be happening after that, right? So that is a very important thing. Number 3, time alignment, right? So like I said, this strategy works the best for the AM session, specifically anywhere from 9:30 to 11:10. Now this doesn't mean that this doesn't work, let's say in the PM session. It still works a lot most of the time in the PM session. Let's say at 1 o'clock, 2 o'clock, it works very well, but I just prefer to take all these trades during 9:30 to 11:10, right? This is my time frame, this is my window where I'm looking for trades, and I want to be done as early as possible. There's rarely any times that I trade during the PM, because usually something happens in the AM. It's either I take a win or I take a loss, or I'm just done for the day in the AM, and there's no reason for me to continue trading in the PM session, right? But let's just say if AM was just super, super choppy, right? We're just kind of having a whole barcode price action. We're not really doing anything. We're not taking any draws on liquidity. We're just kind of going up and down, up and down, up and down. And then you could start to see the PM session, or even the 11 a.m. close to lunch, start to generate liquidity and start to actually finally take out those draws on liquidity, right? So it really just depends on the scenario, right? But for the most time, I'm just looking anywhere from 9:30 to 11:10. These are where my A+ setups happen. And you might ask me, why is it exactly 11:10? Because a lot of the times what happens, sometimes what happens is, let's just say from 9:30 to like 10:45ish, we won't really have any sort of volatility in the market sometimes, right? And then we're just kind of generating liquidity on both ends or whatever. And then usually when that macro rolls around 10:50 to 11:10, that's when price starts to actually take out those liquidities, right? So again, it just depends on the scenario, right? If 9:30 to 11 is just pumping or dumping and, giving you a lot of good setups, for the most part, after 11:10 going into lunch, we're gonna see some chop, right? So, but if it's the other way around, like if it's 9:30 to 11, we're kind of chopping, we're not doing much, then you could kind of start to expect 11 a.m. take out those liquidities, or even the PM session close to 1 o'clock, right? And finally, one of the most important things specifically for this strategy is you have to have a rejection off of a higher time frame PDA, right? So again, this is just anywhere from the highest time frame fair value gaps or previous session highs and lows, previous day high and low. These are the main factors I'm looking at when I'm saying higher time frame PDA, right? So if you're just kind of taking a random trade at like 9:45, right, we haven't tapped into any sort of PDA, right? Let's say we're in a 3-minute fair value gap, like price just retraces back to like a random 3-minute, and then you take a 1 minute long, let's say, right? That is not my strategy, because you're not rejecting off of a high time frame PD rate. High time frame PD rate is anywhere above a 5 minute, right? I would specifically even go up to a 15-minute and higher. So 15-minute, 30-minute, 1 hour, 4 hour daily fair value gaps. Right? These are the fair value gaps that I'm looking at. Or I'm looking at session liquidity. So London high and low, Asia high and low, previous day high and low. These are the main things that I'm looking at. Sometimes I'll be looking at just a very, very obvious high and low. Let's say like a 930 high that got placed, and then we come up, sweep that 930 high, and then there's, let's say, like a very important level below us, let's say Asia low, and there's a 1 hour fair value gap below that haven't got tapped in. So those, in that case, that could also be a very good opportunity for a high time frame PD rate, because that 930 high was just sort of a sweep, right? But for the most time, it's those three things that I mentioned, right? Any fair value gaps above a 15-minute, or previous session high, previous session low, previous day high and low, and very obvious highs and lows, right? So these are the main things that I'm looking at. The reason why these are very important, right, is because this is what will take your, mid setups, for example, like a B setup or B plus setup. It's not that those lower rated setups won't work. They could definitely work. Let's say if price just retraces, took a random 4-minute fair value gap, and then you're just targeting a random high or random low that has no story behind it. There's nothing really obvious about it. It's not that that is not going to work, but it's just not the highest probability. And again, whenever you're in a market, you just want to be taking the highest probability setups. You don't want to kind of gamble or take your chances with the lower probability, because for the most part, lower probability are not going to work as often as an A plus setup, right? So these are the four main things that I look at every single day. If these things aren't happening, you could even see I have a little checklist for myself below, right? We see that I have this on my screen every single time. So anytime I'm about to take a trade, quickly peek down here and be like, all right, is this a higher time frame fair value gap or a sweep? Is there an unfilled target? Is there a highest time frame inversion in that leg? And is time aligned, right? So these are the things that I have right here. And this is exactly what I put up over here, right? So these are the things that you always have to look out for when you're taking your A plus setups. All right, so taking a look at our first example, right? The first thing, like I said, that we have to look at is it aligning with the bias, right? So first things first, we see where is the market, right? We are currently heading up to all-time highs again, right? These are all-time highs over here, right? We made this very impulsive move, right, on last week's Friday, right? I drew my fib, right, just to see this range, and then we see that we pulled it back to this equilibrium level, and we start to now see displacement back up higher, right? So now I can start to kind of expect prices to go up higher, and now we want to see, are there any obvious draws on liquidity, right? So now if you take a look at our targets, right, we see there's equal highs over here, right? There's London high over here. There's another very obvious high over here, and all of this is low resistance liquidity, right? So we have very obvious draws on liquidity that we could potentially target. And what happens now? So pre-market, we come down, we take out Asia low, right? Make an SMT with ES, and we start to see immediate displacement back up higher. So now I'm starting to like this, right? Because what do we also have here? We inverted this 15-minute fair value gap over here, right? This is still pre-market, but this is all showing us the direction that potentially we could go up, right? So we come down lower, right? We pulled back to this 5-minute fair value gap over here, and then now we inverted this 5-minute, right? This is exactly at open, right? So you could have taken this trade, right? It is a little bit of a premium trade, I would say, right? But just for the sake of the trade, you could have taken this trade, right? Targeting this London high right at open, right? What happens, right? We pull back, we take that level, we take this equal high, we take this equal high, and we immediately take out London high, right? So this immediately ended up pumping up higher and taken out. But let's just say for some reason you missed this trade, right? What happens then, right? We now create a 15-minute fair value gap over here, right? And this liquidity and this liquidity is still left there for us to target, right? So this still could potentially work, because why? We have a lot of displacement through this London high, and I'm still expecting bullish plays to work, right? If this was like a sweep, I wouldn't have seen these displacement candles, right? So let's see what happens next, right? So we have price to come down lower, right? And obviously you could kind of get the idea of this trade over here, right? So once we retrace to this 15-minute, right, we have this 2-minute inversion, which is the highest time frame in this leg that ends up occurring, right? Is time aligned? Yes, it's 10:22, perfect time. Do we have an obvious draw on liquidity? Yes, we have this internal high, and then we have this high left, and then we have these low resistance liquidity, right? And if we are gonna take this trade, right, we have the highest time frame rejection, right? This 15-minute fair value gap that is rejecting. Is the bias aligning? Yes, we're literally, as the pre-market shown us, we did all that we needed to do for a bullish place to work out. Now we just want to see a continuation play in this case, right? So let's say we're targeting this high or even this high, just for, if you don't want to shoot for the stars, just, aim for this little almost a one-to-one trade, and let's see how it goes. So you get a little pullback, and then bang, we get that TP hit, right? And again, if you want to hold for longer, let's see if price goes all the way up here for this next obvious draw on liquidity. And we do see that price does end up coming up higher, right, and taking out that draw on liquidity also. So if you did have a lot of conviction, you could have held for this 150 point banger, right? Up to you. But for my case, I would have just held it for this internal high, right? Because I don't want to be in trades for the entirety of the day, right? So I just kind of want to take that little piece of the pie and be done for the day, right? So again, two setups that could have occurred, right? You could have either taken a trade right at open, right, this long targeting London high, or you could have just waited for another continuation long, right, after this London high got taken. With displacement, right, we see the price pulls back down to this 15-minute fair value gap. We also have a VWAP over here that's aligning with it, right? And then we have still this very obvious draw on liquidity and this one left. Everything's aligned. A+ setup, easy money. Taking a look at another example, right? What do we have here? We have previous day high over here. If you zoom out, right, what do we see? Price was pushing down lower, right, and now we're retracing back down to the premium level, so we could potentially see continuation shorts, right? We have all of these obvious lows left over here, right? Now if you come down, right, we have a 15-minute fair value gap over here. We have this 1 hour fair value gap over here. We have this equal low aligned with London low, and we have Asia low that are all unfilled, that aren't taken, right? So we have a lot of obvious draws on liquidity. My bias could be potentially bearish, right? We could potentially see all these targets get hit. So I want to see some some bearish plays, right? So now we have unfilled targets, right? Very, very obvious, right? Our bearish bias, we have a bearish bias, right? So I want to be taking shorts instead of longs. Now, do we have a higher time frame PD rate? This is previous day high that got ended up taken out. We price take it out right here, right? And then we have another internal high, which is another better example, right? Because we just took another sweep of that internal high. Now all we have is an entry model, which is our inversions, right? So the highest time frame in this leg would be the 5-minute, right? As you can see over here. So if I was gonna go and take a short right here, stops above over here, right, targeting literally any of these any of these PD rates, right? So let's say if you're really, really confident in this trade, and let's say you're targeting Asia low in this case, right? And I'd probably go break even in this leg, right? So this is my break even point, and this 15-minute, this is 1 hour equal low with London low, Asia low. All of these are obvious draws in liquidity. We have the whole entire checklist lined up with us. Now let's see if this play works out. So now we see a little pullback, right? And bang. So now price came down, took this internal. You literally could have even just took this if you wanted to. But like I said, let's just say if you are really confident in this play, let's see if price ends up playing out here, right? So we have another push down lower. So we took out this 15-minute and we tapped into this 1 hour again. Could have taken your trade out right here. But let's see if you still held, bang. We ended up catching 233 points. And price ends up going even lower, right? And then after that, we start to reverse, right? So right as we took all of these obvious draws on liquidity, right, you could have taken your trade out at any point, right? You could have just taken out this 15-minute, at this 1 hour, at this London low and equal lows, or at Asia low, or even just at this internal low, right? So you had a lot of options in this scenario, right? This is how an A+ setup again looks like, and these two were just examples of what you should be constantly looking at when you're taking these inversions, right? It's not just like a random 3-minute fair value gap that we took, or something in the middle of nowhere, right? We have context to our trades. We zoom out, we look at the bigger picture, Where are we trading at? Are we looking for bearish plays? Are we looking for bullish plays, right? One scenario, the first example that we showed was a bullish example. Now there's a bearish example, right? And yeah, this is pretty much it. That was it pretty much for this video, right? This is how you take the highest probability setups. Again, just for a quick recap, right? You need to take the trades that align with your bias, right? If you're bullish, you want to take trades and you want to look for longs. If you're bearish, you want to take trades that are aligning with that, shorts, right? But obviously, if your bias is wrong for the day, adjust to it. If market is showing you the opposite, right? If you think you're bearish, but all the bearish gaps are getting closed above and we're pushing up higher, right? Obviously adjust, because being wrong on a bias is not a very a rare thing. It's pretty common that people are most of the time are wrong with the bias, which is completely fine. You don't need to always be right on which direction the trades are going to go. You just need to be adjusting if you are wrong, right? Then obviously you need to have obvious draws on liquidity, right? You want to have obvious highs and lows, obvious fair value gaps that are unfilled, that are untapped, right? Those are still left, so these are very clear draws on liquidity for you to target. And now you have to also align time with it, right? Anywhere from 9:30 to 11:10. Or if you want to trade, let's say PM session, right? You want to go into that, trade the PM session, right? Just have one session. You don't want to trade every single session, because yes, this trade works. I mean, this strategy works literally at any point, at any session. But for the most highest probability setups, it's usually in the morning. And again, finally, and one of the most important things is you need the rejection off of a high time repeated rate. Again, any fair value gap above a 15-minute or previous day high, previous day low, previous session high, previous session low, and or just a very, very obvious high and a low. That's, for example, like a 930 Judas or something like that, right? So that was it for this video, guys. If you have any questions, comment down below. And yeah, I will see you guys in the next video.